Hello, everybody. Welcome back. I'm Rich Curtis with eXp Realty. And again, today I have Dave Miller with me from SnapFi Loans. And today we're going to be going over everything credit. What does your credit score need to be to buy a home? If it's too low, how do you get it up? What does it cost you if it's low versus if it's high? What are the benefits of having a high credit score? We're going to kind of open that black box of what happens in credit scoring and credit reporting. And we've got a bunch of questions that you guys submitted to us online that we're going to go over, like, why is my credit score different on my credit monitoring program than when my lender gives it to me? Does it reduce my score if my lender pulls credit? We're going to go through all that for you today. So you're going to want to sit back, grab a beverage, a water, a tea. If you're watching this at night, grab yourself your favorite alcoholic beverage, strap in and stay with us for a while, because by the end of this, you're going to be a very informed home buyer and know when you need to get somebody involved to help you figure out your credit so you're prepared to buy a home. So with that, welcome, Dave. Welcome back. Thanks for joining us.
Hey, Rich. Thanks for having me.
All right. So I thought we'd start off just with the first general rule. So on the day you get in a contract, when you're buying a home from me, you're going to get this email that says, welcome to escrow and next steps. And in big, bold letters at the top, the very first thing it says is, do not do anything new with your money or your credit while you're buying a house. We say, do not encumber your credit in new ways. That's just fancy language for don't buy anything on credit. Don't open any new credit lines. Don't buy a yacht, a motorcycle, a new car. If you're thinking, I need the appliances for my house, Dave and I have had people pull this one on us, where Best Buy is offering the 0% for 6 months. If you open the credit card right now and you can buy all the new stainless steel appliances for your new house and you're excited and you want to do that, you just have to wait until you close, because every new credit account, every new encumbrance changes your ability to get a loan, costs you money. And in some cases, some people have made such bad decisions, like one client of mine way in the beginning that bought a motorcycle in the middle of escrow, and it cost him the ability to buy the home for a few months until he was able to work that out. So that's, and I don't know if you agree, Dave, or if you have another first rule that you throw out to people.
I do. And Rich, we've been doing this for 20 years. And I think we could just make one segment just on experience if we've had and stories of people that have maybe not heard or didn't think what we were saying really was valid, and, made the mistake of buying a vehicle or, appliances or whatnot. And I say the number one rule, and Rich, you talked about it. We really warn people, once you get into contract, really have conversations with both you and I about, what you can and can't do. And so the first thing, though, is we will have ran your credit before you go into contract. So we're going to have a baseline credit report for you. And as a buyer, we're going to use that. That's usually good for 90 to 120 days. And so the idea of that is we know what the baseline of your credit is. And that doesn't mean you can't, we'll identify what your credit score is, but it doesn't mean you can't use your existing credit if you're in the process of shopping for a home. So, a lot of people use their credit cards, with Apple Pay and whatnot. You're just, almost everything's done on credit. So it's okay to, buy your groceries and whatnot, spend your normal expenses through the month or months utilizing your credit. But what we don't want you to do is go open up new trade lines. There's several things that, rules that we ask you to follow, but it's really about, once we run your credit, you're going to have what we call credit utilization. And so that really affects your credit score. What do I mean by credit utilization? It's really, there's a couple components to that. And one would be like, how many trade lines do you have? You might have like a Visa card, a MasterCard, a Home Depot card, things of that nature, an auto loan. And so there's, what we call revolving debt versus installment debt. So installment debt doesn't typically change. That's like your auto loans. If you have a mortgage, personal loans, where you almost have a fixed payment every month and a fixed, initial credit limit that you're just reducing, an auto lease, for example, that you're just reducing every month. So I'll pause for a second. Any input there, Rich?
Yeah, well, one thing that struck me is when you're talking about, we've got a 90 to 120 day, you establish your credit. It's good for 90 to 120 days. That's kind of good for our shopping period. So if you get your credit pulled by Dave and it takes us 30 days to find your home of choice, we're not rerunning credit at that point. But Dave, talk about when we are rerunning credit, because it's after that. Sometimes people get the impression that, well, Dave ran my credit, now I can go buck wild and buy the motorcycle.
Right.
But there are points where it's rerun again to make sure things haven't changed, and that's where people really get caught out. So can you talk about how many times the credit's run and when it's looked at, and when people have to sort of be minding their P's and Q's credit wise?
Yeah. Really good point, Rich. So when we initially run your credit, it's there's two different types of pulls that we can do. We can do what's called a soft pull, which really doesn't affect your credit score. And then there's a hard pull, which provides a bunch of additional information that we don't get on a soft pull. So before you get in a car and you go start looking at a house, we are going to do a hard pull. Sometimes if you're not quite ready, we would do a soft pull first before when you're just inclination, you're thinking you might want to buy a house. But typically, and then once you give Rich a list of properties or things sometimes can move really fast. So I always inquire, let's do a hard pull early, which is good for 90, let's just say 90 days, for example. And that's going to tell me what your credit score is. Now, we will not pull another hard pull on your credit. We will do a soft pull just prior to funding. And that's within 3 days of funding your loan. And that soft pull is not, and I've seen it a lot. Well, that soft pull, we're not looking at your credit score. What we're looking at is any new trade lines that you've acquired that would affect your debt, or potentially affect your debt to income ratio. Because that's a big hurdle for loans is from a qualifying standpoint is debt to income ratio. So the ability to qualify. And it's amazing if you can go open up a credit card that's, you bought a TV, and TVs are cheap now at $500. So you went to Best Buy and you got a credit card because you saved 5%. And now all of a sudden that $50 a month payment, we have to recalculate everything and start over. So you don't want to go open up any trade lines after you're in contract, or really once I've pulled your credit, if you don't have to. But we will talk through it, and I have a pretty good idea of what you can and can't do after the hard pull, and we'll make recommendations and we're going to err on the side of conservativeness, because also when you look at credit scores, there's not necessarily, these algorithms are quite confusing, and there's never a clear answer of what really is going to, how it's going to directly impact my credit score if I go add a new trade line. We have a general idea, and again, it gets back to credit utilization. So if you have 15 credit cards that are low balances to the limit and you open up a new card, it's probably not going to be a major hit. If you have 2 or 3 credit cards and you open up another credit card, that's potentially 25% of your credit is now on one card. So that has to do with credit utilization as well.
Yeah, and that gets into this sort of the black box nature. Some of this, even after 20 years, some of what's going on your credit scores and your credit report and how things are affecting you, is it's happening in these sort of black box environments at the credit reporting agencies that Dave and I have no access to. We'll go over in this podcast, we'll go over what we do have access to, but that's why we're so conservative with it, is because you kind of never know. Small things can catch you out. So when Dave says we're going to do another pull at funding's the end of the line. If you never bought a home before, funding, we're talking 24 to 48 hours before you close the home, at the very end of the line. Maybe in a rare case, we fund on a Friday and closing ticks to a Monday, and you might get 72 hours, but this is not something that's happening 2-3 weeks before. So you really have to keep your act together financially all the way through to the finish line. And that's kind of the most important piece to know, that as you're running up to this thing, it's important to get a lender involved early. It's important to get that baseline credit going and to get some information from that lender that's specific to you, not a list of little recommendations on a website somewhere, but that's specific to you, what you can and can't do with your money over the next, whatever that be. Maybe it takes you 30 to 45 days to find your home of choice, and it takes us another 30 days to close it. Maybe a little bit more. You could have a 2 to 3, at the height of the pandemic, when it was insane and it was really hard to get buyers in, we had people almost 1 year cycles looking for a house and really having to mind their P's and Q's and be in constant contact with their lender to make sure they do that.
Yeah, you bring up a good point, Rich, in terms of people viewing websites and trying to decipher what they can and can't do. And most consumers today have access to their credit, whether it's Credit Karma or through their banking website or their credit cards. Keep in mind that, and I've had people come to me, oh, what's your credit? Do you know how your credit is? And I always ask the question when I'm speaking to a new prospect or a new potential home buyer, how is your credit? Because today, most people have a general idea how their credit is. Some people have no clue, but if you're paying your bills on time and you have good credit utilization, usually the credit's good. And I can almost tell from the conversation how that credit's going to be. But I've had people come to me and say, oh, my credit's great. It's 760. I just, looked at it yesterday on Credit Karma. Well, when I run your credit, because it's also industry specific, so a mortgage credit that I run could be significantly different. I've had someone say, oh, I just saw my credit at 760 and I run it and it's, 690. Big swing.
Yeah.
And that makes a big difference in terms of qualification and cost.
Well, that's a perfect segue into, we reached out on social media. We asked you guys for your most common questions. We pulled out the top ones, and these really line up with the top things Dave and I get asked all the time. Right. And two of the first ones. So we'll just go with the first one here, which is, what does my credit score have to be to buy a home? So what's our baseline, Dave? What's it like bare minimum we need to buy a home?
Bare minimum, and there's different loan programs. Usually we'll say 580 is the bare minimum. As a rule, once you start getting over 600, 620, much easier. And there's different loan programs such as an FHA loan, which will allow for lower credit scores. And lower down payment, but there's some, things that come along with an FHA loan, which will be a separate conversation versus what we call just a true conforming, like a Fannie Mae or Freddie Mac loan, which is going to, you can qualify, in the low 600s, but there's a significant cost for your interest rate for those lower credit scores. And I'll be prepared here once we're ready, Rich. I can pull up a graph and kind of show the adjustments based on your credit score.
Oh, perfect. Yeah. So baseline, we need to be around 580 to even start to be thinking about buying a home. And
Correct.
Things get better around 620-ish.
That is, yep, exactly.
In terms of rate.
Yep.
And then what if we're a rock star and we're going to get, what's the bare minimum credit score to get the best rate available? In other words, above this, your credit score doesn't help much.
Usually 740 is really that kind of credit score that if I see over 740, any loan program, any option out there, you're going to get, the best rate. But that also brings up a point. It's, you can get any rate you want. It's the cost to get that rate. And so there's
correct.
Yeah. And so there's, what we call loan level price adjustments. And I'll just give you, before we turn to the chart, I give a basic example. So if you're buying a house and say you had you're going to do a $500,000 mortgage, and at 740, there was no loan level price adjustments for that. Or what the cost to get that rate, versus if your score were to drop and say it was 680, and hypothetically, if it was a half a point, a 0.5 loan level price adjustment, it's going to cost you $2,500 more just to get that same rate based on your credit score. So I usually
So in everyday people speak, loan level price adjustment is just a fee you're paying to get the better rate. Your credit score qualifies you for X rate, whatever that is. Yep. You wanted a better rate. You can pay this fee to get a better rate.
Well, that's different than a buy down. So that's similar. So all things considered, if you have 740 credit score and you come in and there's no real price adjustment. In fact, let's do this, Rich. Let me share the chart, and because this will show the different price adjustments here. And
so for folks following along, while Dave's pulling along that chart, we have this spectrum. You're not even able to get on the field and start playing ball and looking for a house unless you're 580. Things get significantly better for you at a 620 credit score, and 740 or above, you kind of have the best access and the best pricing available to you. Now, you might be able to get the same rate that a 740 credit score has if you're a 620 credit score, but it's going to cost you money. And that's what Dave's going to show you some examples on the chart of what that might cost you.
Yeah. So here's basically a Fannie Mae loan level.
Let me pull that up, Dave. Let me throw that on the screen. There we go.
Okay. There we go. Okay. So we're looking at a Fannie Mae loan level price adjustment in the industry. We call them LLPAs. And I'm going to start here over I don't know if you could see my cursor here, Rich. I just highlighted 700 to 719. So we'll just start here in the middle. And so we're looking at loan to value up here in next to credit score and loan to value range. So if you I start here at 700 to 719, then we go somewhere in the middle here. So if you're putting 20% down, you're at 75 to 80%. You can see there's a 1.375% loan level adjustment. So
in order to accomplish what for our viewers?
Yep, for your buyers, that's an additional cost to get that a specific interest rate.
Gotcha.
So
and in
based on
today's
credit
numbers,
score. Yep.
what that
1.375. So just simple math here. If you just take if we use a $500,000 mortgage, I say simple math, but I'm using my calculator, times 1.375%, that's 6875.
Yep.
6,008 to get a now keep in mind that doesn't mean you have to pay 6875, but what's going to happen is you're going to use a interest rate adjustment. So that means you're going to be forced to take a higher interest rate to not pay the 6875. But if I go straight up this chart all the way up to the top, now you see 0.375. So if you have someone that here is over 780 credit score, so, and again, I said 740 earlier, that affects you less when you're, based on different lower LTVs, but you could see the 75 to 80% here. Over 780, there's still a 0.375. So now if I move left one window here, if I am putting 25% down, now I don't have a loan level price adjustment.
Gotcha. And the 1.375, say, what does that buy a difference in rate from? So you're paying 1.375 if you want to change the rate, how much?
Yeah, that's probably going to affect the rate to it's probably somewhere near 0.5% in interest rate, which could be the equivalent of, let's just say, $40 a month per eighth in interest rate. So 0.5 point, you're looking at, that could cost you, in higher interest rate, upwards of $200 a month.
Yeah. So that's dramatic. The difference in cost to save yourself $200 a month between a 700 credit score and a 780 credit score is almost 1 full point, right? Almost about $5,000 on the loan value we're talking about. That's the difference in cost.
Yep. That is 100% accurate, Rich. And so and as a consumer, as a first-time home buyer, please don't go looking at these charts. And so, because what happens is what I'm going to do is I'm going to run your credit, and you're going to have your baseline credit score and your baseline interest rate based on your credit. That's where you sit. And then I will make some recommendations to you. So for example, if I go, let's see where there's a big jump in this chart here. So just the difference here, if you go one below that 0.375%, so there's basically a 1/4 point difference here in between, or an 1/8 point difference. Sometimes there's not a significant jump, but sometimes there is. So you can see right here, there's a 3/8 difference in rate between 739 and 740 credit score right here. So you could be, 3/8, you're talking, over 750, upwards of $1,000. And that's where I'll say, if your credit score is at, 739, I will be able to look at your credit report, make some recommendations. What can you do to get your credit up during this home buying process by 1 point? And there's some things that we can do, and we usually have time to do that. 9 out of 10 times, I'm able to make a recommendation, and I'm able to do a repull to improve your credit if it's going to save you some money.
That's a great point. And one of the reasons why it's so important to get a lender involved early in the process. So if you call me to show you a house and you fall in love with that house, now, because I'm a professional realtor, I've been doing this 20 years, I'm not even going to take you to see a house unless you've already done this loan pre-qualification process. But in some cases, realtors will. So if you're in a different market, if you're not working with Dave and I, if you're working with a new agent that's just sort of hungry and wants to get you out there and doesn't care if you're qualified, they just want to, have someone to talk to and get in the car with, which unfortunately happens if you're working with somebody younger in the business. If you go out, you find your home of choice, and then you're scrambling that day to get a loan pre-qual and get you into contract. Yes, we can do all of that. That's possible. We can do all of that in the course of a day because we've been doing this a long time, but then you don't have any time. Your only options are pay the difference to get the rate you want, right? Versus if you get Dave and I involved, 3 months before you even start looking, or even just as little as, a week or two, sometimes before you're looking, he can make a recommendation that says, hey, let's just bump your credit up. And so instead of having to pay the $5,000 difference, let's bump your credit up so that you have a higher credit and you get that rate anyway. You don't have to pay the difference. And here's the 3 things you can do. And Dave has access to tools that us mere mortals don't have, things like a rapid rescore. He can have you do some things and then it kind of explain that process, Dave, how right after someone makes some adjustments, you can get the credit score to move for them.
Yeah, that's a really good point, Rich. And so when your credit is established through your trade lines, and I talked earlier about the different trade lines you can have, but there's different when you're a consumer and you use your credit card, there's when companies report, so Best Buy, whoever it may be, when you're using a credit card, your Wells Fargo, auto loan, whatever it may be, all creditors, they report at different times during the month. And so we can do some things where, maybe you have a credit card, and one of the things that really affects credit scores is utilization on debt. So say you have a credit card, for example, and you have a $5,000 credit limit, but you've borrowed $4,500 on that. Well, if I want to get your credit score up, ideally, we want to get that down below 50% or 33%. There's different levels, but if we know that getting that down below 50% might bump your score by 15, 20 points. And I use a credit reporting agency service that they will tell me, by doing this, most likely this is what the outcome's going to be. So maybe you have a few extra bucks in the bank, and you just write, and this happens sometimes where people do pay a big chunk towards their revolving debt on a monthly basis, but it's based on when the creditors report is what your balance is. So you may usually pay it down way lower, but the creditor reports, today's today, the 28th of the month, or, whatever it might be, the 29th. But then they might turn around, and by looking at your credit report, this particular creditor is going to report on the 11th. So we have until November 11th to get your credit down. But say we're buying that house and we want to see your credit before November 11th, go ahead and make that payment. And then we could do a rapid rescore where we can have that creditor report what your new balance is that may affect your credit. And I could do that in usually 1 to 3 days. There's a cost to get it. It's not a significant cost. Typically it's on average $25 per bureau per trade line. And, we can go deeper into that too at some point, but that could save significant amount of money. You could see just by increasing your credit score by, anywhere from 1 to 25 points could save you a significant amount of money.
Yeah, and that's an incredible tool that Dave has access to as a professional lender. But, one of the things I think people, and I addressed this in another video, I think people tend to not want to talk to a lender or a realtor early on in the process. And I think that happens for several reasons. One is respect. They don't want to waste our time because they know their finances are a bit of a mess and they're not ready yet. 2 is some people are a little embarrassed as to wherever they are on that financial spectrum, right? And now to put that in perspective for everybody listening today, I've been in real estate 20 years, but there was a time, and Dave likes to laugh at me, I was a professional raft guide for over a decade. I lived in the back of a 1987 4Runner down by the river, Chris Farley style. I made $8,000 to $12,000 a year. And so for me to approach a financial professional and talk about how do I buy a house when I'm making 8 to 12 grand a year, it just was something that didn't feel good to me. I felt like I had to pretend to be in a place I wasn't, and nothing could be further from the truth. The earlier you get involved with somebody like myself or Dave, I don't care if you're a year or 2 years out, you might be working the Dave Ramsey debt snowball program to pay off all your college debts and all your credit card debts because you're just kind of engaging with getting your financial house in order. The problem, that is a great way to do it, a great system. But the problem is somebody like Dave might say to you, hold on, don't pay off all those credit cards because you need more reserves or you need more cash in the bank to cover down payment and closing costs that I'm going over with you. And so you may need to pause that program a little bit or adjust it so that you get to where you want to go quicker. So don't try to do these things in a vacuum without professional advice because you're not ready yet. I am most happy to talk to somebody who's not ready yet, point them in the right direction so they can get ready quicker. It's a free service we provide to our community with no judgments. Let's start where you're at and point you in the right direction so you can get where you need to go.
Yeah, I agree 100%, Rich. And it really comes down to timing, and everyone's timing is different. Like Rich said, you may be in a situation where, you're a raft guide, but maybe have a degree, or you're getting ready to start in a new industry, or you're whatever it may be, or you expect your income to increase over time. But it's never too soon to start the conversation with us. And when I talk about timing, it's really that timing of what you're going to do with your debt. So you may be someone that you do qualify to buy today, but you have a fair amount of credit card debt. Does it make sense to just pay that down right away? Or does it make sense to save that money for down payment? Then as soon as I close the house, then I pay that down. We will talk about all different types of scenarios, and understanding every consumer, every new home buyer is unique and their profile is unique. And so, and when I talk about, we have these conversations and we do podcasts like this, and people think, oh, well, I'm going to go ahead and go take care of this. Sometimes people do things that say, okay, well, I got all this credit card debt. Here's a new credit card with a new intro interest rate. I'm going to move all my debt into there because I'm now paying off. Well, what you did was really good in theory, and you're saving yourself some money. But it just tanked your credit score for the next 6 months. Because typically when you open up a new trade line, there's seasoning, what we call seasoning on trade lines, as well as debt utilization. So sometimes that could have a big negative effect. So maybe if you want to do that, you wait till either after you buy a home, or you come to us early and say, hey, you're 6 months to a year out from buying a house at least. Let's use that 0 APR card. Let's go ahead and consolidate your debt. And then we'll revisit this in 3 months or 6 months and stay on a regular cadence where we're having a conversation.
Yeah. And seasoning, I try to pick up, when you've been doing this a long time, it's nearly impossible for us to strip all of our jargon out of the way we talk. Seasoning is just the duration of time you've had that particular credit instrument or credit card or line of credit, whatever it is. Mm-hmm. And, in general, the less time you've had it, the bigger negative effect it's going to have on your credit. The longer you've had it, the less negative effect it's going to have on your credit. That's why this opening new trade lines while you're in escrow or while you're preparing to buy a house, that's why that's so bad, because there's no seasoning on that. Meaning the credit reporting agencies don't have a history of you paying that enough for them to feel confident that you're going to pay that. And so they hit you harder on that one, rather than if you've got your student loans that you've been paying on for 15 years and you've made the payment every single time, they're not so worried about that one.
Yeah.
Right.
And I think the most important thing when you're talking about that, Rich, is life happens. And again, we could talk through a million different scenarios and then, probably 100 different scenarios that you and I have faced over the years. But, it just happened 2 months ago where I had a client that had an auto loan. It would just season 6 months and they got in a car wreck. The credit the insurance company was going to send them a check, but now they need a vehicle to drive. So, sometimes, you may have to rent a vehicle for a month if you're in the process of buying a home, instead of going out and buying a new loan and open up a new auto loan. So just talk it through us. And sometimes there are situations where you just can't avoid it, and we just got to be prepared for it. So the number one kind of tip to that is share all this information, because surprises are what will hurt you. And oftentimes we could talk through and strategize the best approach to acquiring that new debt if you have to.
Yeah. And that's a service we're happy to provide, sort of outside of the realm of a transaction. It doesn't matter to us if we're not working together now. We're going to work together at some point in the future. We're going to work with your friends and family. We're happy to provide you that free advice. We have a shared client right now. And this is one that took a lot of thinking through on my part, working through it with this client, but he's going through a divorce, and he just had a major car wreck, absolutely totaled and annihilated his truck. And he's calling me. He's like, hey, I'm at the dealership. I'm looking at this $70,000 truck. Should I do this? And we now are in a situation where, in order for you to keep your home, we have to qualify you for your home without your wife's income, which is already a stretch. And if you encumber your credit by another $70,000 to buy a truck, game over. You're not going to qualify. And we had to have that exact conversation that said, hey, go buy a beater for $5,000 or whatever you need to do to get through until the other side of the divorce, refinance the house, then go buy the car. The auto dealerships are a lot more lenient with your credit situation than the home loans. You can get the house nailed down and buy the car, but the other way around will hose you almost every time.
Yeah, that's a good point. And, the day we close on that home purchase, you're free reign to do what you want to do. It's not like you have to wait, a significant amount of time. Once you've closed that loan and it's funded and recorded, you have free reign. We're not going to tell you what you can and can't do anymore. So sometimes you feel like, here you are, an adult with your own, money in the bank and credit cards and whatnot. And here you are asking guys that maybe you haven't even met face to face yet. What can I do? What can I buy? And the reality is we're just going to give you the best advice that we can so that, you are best prepared to maximize this opportunity for yourself
and reach whatever goal you're trying to reach right now when it comes to real estate. So we've gone over the biggest question, like out of all of them, the one that percolated to the top, of course, was, what credit score do I need to have in order to buy a house? So we established that 580 gets you in the door. You can start shopping for a house. 620 gets a lot better. 740 better. 780 and above gets you whatever rate you want access to, really, for the cheapest cost. So that's kind of the landscape there. We've gone over what would it cost you if you want the same rate from a lower credit score to a higher credit score. And we've seen this can be thousands and thousands of dollars, depending on the purchase price of the home. $5,000, $6,000, $7,000 it might cost you, or you have to accept the higher rate to not pay that amount. The reason we generally work on this show with around $500,000 purchase price is because in the greater Sacramento area, the median home price is $516,000. In the Placerville area, median home price is $500,000. El Dorado County, it might be $650,000 to $685,000, and that's because we have the high price markets of El Dorado Hills at one end and Tahoe at the other end, driving that up. But for the most part of most sort of everyday normal communities in El Dorado County is going to be around that $500,000 median home price. So working with a purchase price of $500,000 or a loan value of $500,000 gets you in the ballpark for most of the communities that we serve, and it's a good even number to work with. So you've seen you could spend $5,000, $6,000, $7,000 depending on your credit score. So these things have impact, and it's worth getting good advice up front. One of the next questions that we got that a lot of people asked, and a lot of you already know this, but some younger people, especially starting out, maybe don't have credit monitoring, maybe don't know. So how can I find out my credit score? And then I'll have a follow-on to this, which is why the credit score they find out might not be the same one you give them, Dave. But what are some ways people can find their credit score out there? Some free ways to just start to get a sense of this right up front before they have to even call us.
Yeah, I think that's great, Rich. Is most credit cards today offer some type of credit monitoring. So if you have a credit card or through your bank, and if you do online banking, you may see advertisements for either periodic or and every time you open up a new trade line, you could ask what your credit score is. There's services out there like Credit Karma. Reach out to us. We'll give you a list of the ones that we're most favorable to. But I think everyone that has any type of consumer debt right now or credit card typically will have access to that free credit score. And you could also subscribe to the bureau. So there's countless ways to really get this information. And again, it's always going to circle back to what industry am I looking at? So again, a mortgage interest rate or credit score, I should say, is going to be different than a credit card credit score. So
yeah, that's a good point. And also when you're looking at these, start with what you already have access to. Start with your own credit cards. You might not have even noticed there's a tab inside my primary used card that just says credit score. You click on it, it gives you a credit score and the date at which they produce that credit score. And that's free. If you go out and search for a free credit score and you sign up to get a free credit score, do be advised that 90% of the time they are signing you up for a monthly program that costs and will rebill without your knowledge. So if you are going to go that route, which I don't recommend, you don't have to, but a lot of my clients end up doing that, then just make sure to set yourself an alarm to cancel that thing, because a lot of them are charging for that.
Yeah. And and I think if you are, paying your bills on time, there's all different types of folks. The number one thing I would say, if you're even considering, is don't be late. That's the first rule. Make that minimum payment if you can on any credit card. Try not to be late. And there's different lates that could affect your credit score, a 30, a 60, and longer, but really try to avoid that late. That's the number one thing that you can start with, is, be in a situation, and we've all ran into it. Oh shoot, I didn't make that credit card payment on time. And so there's a difference too with, most of us are motivated by money to make our payment on time, because if you're late, there's going to be an additional charge for being late. Then there's that other, penalty that you can be beyond the payment, but they're still not going to report that to the bureau. So that's the second thing, is don't be so late. You're better off, if you can't make the payment, pay the extra service charge to be late, but do not go beyond that additional 30 days, because that's when they're going to report to the bureaus. And that's when we're going to see that 30-day late. So there's different aspects to managing your own credit. But those are the things that we get caught up in day-to-day life, and sometimes we miss something. But especially when you're thinking about the home buying process, be hyperly focused on making sure all bills are paid on time.
And those are some of the things that catch people out, where they come to Dave in an initial conversation. They might say, yeah, I got an 800 credit score because they checked it 6 months ago or whatever. Everything's good. And then Dave pulls it and he's getting a different number. So there's several reasons why you and Dave might be getting a different number. One, you may have just not noticed that you made some late payments, or I mean, I once went on vacation to Europe and I prepaid 3 months of my mortgage, and my mortgage company didn't apply them monthly. They just applied it all as one big extra payment to principal, and started to foreclose on my house while I was gone for 3 months.
That
like
sounds relaxing.
Yeah, that was lovely.
Yeah,
So, but it's just something that happens. Things happen in your credit that you don't know about. So that's one reason, one surprise. We had another client where they had a 10-year-old collection for $50 from T-Mobile from some college cell phone account that they didn't know about. It had been going to an address that they hadn't lived at for over a decade. And they had gotten in contract to sell their house. I told them, this is a note for sellers. I told them, have Dave pull your credit before we get you in a contract to sell your house, because we can't get you out of that. And they said, well, we just bought a Tesla. It was fine. And they didn't listen. We got them in a contract to sell. We went to buy that. Someone sold that debt, that T-Mobile debt, to a, Joey the knee breaker style credit agency who didn't know what they were doing. They reported it on the credit report in a weird way that made the wife's credit score unreportable. Her credit score could have been 5 and the husband would have been able to carry it, but it was unreportable. It took months and like 14 lenders to find the solution to or not months, weeks, thankfully, like 3 weeks and 14 lenders to solve that problem. We eventually got it fixed for them. It was a lot of work, but had they just contacted Dave up front, like I'd asked them to, and pulled that score, they would have been fine. So so it's those surprises, things you just don't know about, that make the score different. And there's also, Dave, if you can mention, a lot of times, depending on the credit report, monitoring system you have, they're only monitoring one bureau, and there's 3 bureaus that report.
That is
and
correct.
You have to pick. You have a way you have to deal with those 3 scores and which one you use that might make the number different. They might be seeing the 800 because their credit monitoring system showing them their best score, but which score do you use? How do you handle that for home loan purposes?
Typically, when we run a credit report, we're going to do what's called a tri-merge. So we're going to get 3 credit scores. It's going to be the Equifax, the TransUnion, and the Experian score. And so not all creditors report to all 3 bureaus. And so you might get a different score. And also the things that creditors report to the bureaus might be a little bit different. And so, what we're going to look at is, and when I showed you, when we take a consumer's credit score, you have 3 scores. We're going to take the middle in value. So if you had a 720, a 725, and a 680 credit score, we're going to use the 720. That's going to be the middle score that we're going to use. And so there's often times where, and we talked about a rapid rescore, things of, if we're using that middle score, and if that middle score is 719, and I think, 720 could save you $750. And I say, hey, Rich, go ahead and pay down that, that Visa card that you have by $300. You're going to pay it anyway. I'll do a rapid rescore. We got your score up to 720. You just saved $750. Now, keep in mind, we don't always need to do a rapid rescore. It's just based on timing. So if if you're not in contract yet, and I see that creditor is going to report in 2 weeks, I say, hey, Rich, make a minimum of a $300 payment. So when that creditor reports on the 11th, we're going to see your credit score should bump over 720. Even though I already pulled your credit. So keep in mind, I already pulled your credit at 719. You go buy a house, you've paid that down. Now this is where you get the best of both worlds. So I could either have done a rapid rescore, or I could go re-pull you knowing that situation, that you've increased your credit score. And now I get to use that higher credit score, even if we've already locked you in. I get to go in and say, okay, well, here's the price adjustment. I showed you those extensive loan letter price adjustments. But now we get to use the better score because we can document it.
Yeah, that's a really good point. So you can choose to lock in the interest rate that you want, and knowing that there's a fee for that, and then repair the credit, and then the fee goes away. You've locked the rate, but what you're going to pay for that rate isn't locked. So that these are some things that Dave, it's why it's so important just to get a lender involved early, because you can see little bits of advice, little bits of money, tiny swings can actually make a big difference when it comes to credit. That's why this is worth spending a full podcast episode on. This is probably the single thing that will have the largest impact on you financially when purchasing a home, other than you having representation in the negotiations, obviously not trying to swing that one yourself. But this is the single most important thing that determines your financial future when buying a home. So it's important to get advice early and get this right.
Yeah. One last note I'll piggyback on that, Rich, is we talked about the cost to get the interest rate. There's another component to that is also very significant. And we talked about how much money you're going to put down. Credit score isn't just a loan level price adjustment, but you may be familiar with what's called mortgage insurance. Anytime you're putting less than 20% down, which a lot of mortgages today are less than 20% down. We talk about a $500,000 or $600,000 purchase price. You don't have to have $100,000 or $120,000 in down payment. You can get away with as little as, we'll say 3.5%, or that's a separate conversation. But if you're forced to have mortgage insurance, your credit score will greatly impact your monthly payment on mortgage insurance. Primarily for these Fannie Mae and Freddie Mac loans, not as much for FHA. Those are usually locked in. And so we'll look at the differences. Is if you have a lower credit score, you're putting less than 20% down, we'll make that determination which loan program is best for you, and also include the cost of that monthly mortgage insurance.
Yeah, right. It might be that if you're in the low down payment range and you're looking at an FHA loan where the PMI is just locked in, everybody's got to pay it no matter what, but you have a really good credit score, but just not a lot of money, it may be better to go conventional because your credit score will bring you a lower PMI and bring a lower payment overall.
Yes. And knowing with that conventional loan that you can drop the MI at some point in time. Where with the FHA loan, that's going to be perpetual for the life of the loan.
And that's another whole episode to kind of go through deep on that. But the concept is the same, is that in addition to just rate, and there's other things that affect your payment. And most people, due to affordability now, are putting down less than 20% on a home, which means private mortgage insurance, which is basically just a fee you're paying because the person loaning you the money sees you as a bigger risk because you have less skin in the game, less money on the table. You're less likely to walk away from a house if you have 20% of your own money in it than you are if you have 3% of your own money in it. So below 20%, that's a risk barrier for people who provide loans, and they decide, I'm going to charge you extra because I think you're riskier. And the higher your credit is, the less risky you are. And so the less you'll pay for that PMI, depending on the loan program you choose. Now, if you're already starting to bleed from the ears with all this, we get it, right? It's a lot, and you don't need to know all of this or maintain all of this. We are going to give you the best advice, put options in front of you, and you can choose your own adventure. The point of this is to give you an idea of how much goes into all of this credit business and what you can do to make sure you're in the best place to buy a home. And that is to be monitoring your credit, paying your bills on time. And if you're going to decide to buy a home, get a realtor and a lender involved early in the process to give you really high quality advice in that regard.
Right. Yep. Good point, Rich.
So Dave, one of the other questions that came through, how can I improve my credit score and who can help me with that? You've talked a little bit about maybe about paying on time, about, putting some money onto different credit lines to bring the overall amount of debt you're carrying down. But just from a 30,000 foot view, a couple of tips on what they can do to improve their credit score, and then who can help them do that.
Yeah, that's a good point,
Rich. If they need advice.
Yeah. And so there are other services that will provide credit repair. And so things like if you have some lates, and maybe those lates don't belong to you. Maybe you have some trade lines that are reporting on your credit report that don't belong to you. I've done this for 25 years, and I've dealt with, in fact, me and Rich joint clients again, where, you're, Dave Miller the second or Dave Miller the third. And now my dad's credit score is reporting on my credit report. And there's a whole process to getting that removed or taken care of. And so there's ways that you can do this yourself and write the bureaus, and I can provide you some recommendations and advice. And there's also services that you can pay for that I can recommend based on time. Again, really comes down to time. How much time do you have? And do we need the assistance of a third party to help not only expedite this, but leverage their expertise, which is even deeper than mine, to really, help improve that credit score?
Yeah. So the sort of the order of operations there is, if you're not in our market and you can't reach
Yeah.
out to us directly, if you're in our market, that's El Dorado County, Sacramento County, Amador County, Placer County, that kind of area. Reach out to us directly and we can help you out with that. If not, we can refer you to somebody. Or if you have a trusted advisor in whatever market you're watching us from right now, reach out to the realtor that you trust, get a recommendation to the lender that you trust. That lender will start this process with you. And then depending on your situation, they'll recommend how deep you have to go. It might be just them making some recommendations and doing a little rescore work, or they might say, hey, here's this third-party credit repair agency I work with that will help us take this to the next level for you. But the point is, you are not, wherever your credit score sits now, you're not stuck with that. There's a whole landscape of things we can do as long as you come to us early and get some good advice.
Yep, I agree.
All right, now this one, people do this all the time. One of the other reasons my clients are reticent to get a lender involved early is they're afraid of the rate pull bringing their credit down. Maybe they already have a little bit of knowledge and they know, oh man, I'm 740, and if you pull my credit and my credit and it makes my credit score go down, now I'm not going to qualify for the best rates. Or I might be shopping and talking to a few different lenders, and I don't want all of them to do that because my credit score might come down. So can you talk about the effects of a credit pull and the difference between sort of, getting a car loan pull and what you're doing for a mortgage, how that affects the credit, how long that affects the credit, and what a good strategy is there?
Yeah, that's a good point, Rich. And I think the credit reporting agencies are keen to the fact that, people are sometimes shopping around, whether it's with an automobile or a home loan. What really affects you. So if you come to me for a mortgage credit, typically that's going to hit your score about 3 points, that initial pull. And then, we have a timeline. So within the next 2 weeks to 30 days, if, for whatever reason you went to a different, or you had your credit pulled from another mortgage guy, Rich said, hey, talk to Dave. You say, I don't want you to pull my credit. Well, I don't have to necessarily pull it right at that second if you know what your credit score is. But if you're going to get in the car with Rich and you're going to go looking at a house, I want to verify it for myself, but it's not going to impact your credit score, but just a very small amount, maybe up to 3 points, because we're just another lender in the same industry is pulling your credit. What you don't want to do, which has the biggest impact, is I'm shopping for a mortgage. I just had my car pulled my credit pulled at Toyota. I just went into Best Buy and they pulled my credit. So different industries running your credit is a big red flag for your credit score and the credit reporting agencies. And so when I run a credit report, it's going to give me risk factors of why your credit score is what it is. And it could be too many inquiries in a short amount of time. That's usually not too many inquiries within the same industry, meaning you go to Toyota and then you go to Chevy or Hyundai or whatever, and that's going to have very little impact on your credit score. It's when you go outside and you start looking at different industries to have your credit pulled. And a lot of people, they love it. I mean, you get a lot of offers in the mail, on your email, and there's things you could take advantage of, but it's not always going to save you money in the long run by taking advantage of credit offers. So.
Yeah, so that initial pull is going to hit your credit score maybe 3 points, and if you were to go to a couple of different lenders, it's not going to have that much impact because the story to the credit reporting agencies makes sense. You are shopping for a home loan, but if you went to the yacht dealer, the motorcycle place, the truck place, and the house place because you were trying to decide what you wanted to spend your inheritance on, all of that could really nuke your credit score, jumping from industry to industry and having multiple pulls. Now, how long does it take, Dave? So say you pull their credit and it drops at 3 to 5 points, whatever.
Yep.
How long until the credit reporting agency says, all right, that's not that big of a deal, and it kind of bounces back?
Yeah, that's usually, it'll start, after 30 days, then time just, more times. Then there's 60-day window, then a 90-day window. Then after a certain amount of time, then those inquiries start to fall off.
Gotcha.
And so, and each, I don't know that there's really a set timeline. Each industry might be a little bit different. But, again, and we find that this happens, no matter what. Someone's looking to buy a house. They probably hadn't applied for credit in 6 months to a year for something, but when they decide they're ready to look for a house for some reason, last month, they did a couple inquiries. And so,
Yeah.
that's just the nature of the business, but we'll let you know, like, okay, no more inquiries, or if you have to get an inquiry, when do you do that?
Yeah, and so that's if this really isn't something to worry about is the point. So if you've chosen a lender, let them pull your credit, because the effects to you of not getting the advice you need to repair that credit so that you get the best rates and the best costs for everything far outstrips a few points of a hit on your credit report to have the credit pulled. So it's always in your best interest to have that credit pulled right away by the lender of your choice. Now, if you're going to shop around and you're going to talk to 3 or 4 lenders because you don't have a trusted advisor who's going to give you a referral or a recommendation, then, one thing you can do is use that credit reporting, agency that you have, pull that score and talk to 3 of them and say, quote me based on this score, right? And you just give them all the same score. You get all the same quotes back. And, I think we'll do a video on this for you. I have a video on my channel that is ways to vet a realtor, how to pick a realtor. That you certainly could apply to me too, but it's also intended for if you're out of market and you're trying to find somebody. How do you evaluate? How would I choose a realtor if I went and airdropped into Tennessee and wanted to buy an investment property? What criteria would I use to choose the realtor who's going to represent me? So I'm certainly not going to represent myself in a market I don't know. I'm going to use a trusted advisor. So how would I pick them? Dave and I can do one to help you. How do you pick a lender? How do you vet that person? But it's much, a little difference in rate, a little difference in fees. Those aren't what affects you. How long has this person been in the business? How do they problem solve? Can they help you repair your credit? How are they adding value to the transaction? They can answer your call at 7:00 on a Sunday night if we're having problems and the deal's blowing up. These are sort of some of the things I look at. So if you just sort of level the playing field and you're shopping 3 lenders and you just give them all the same credit score and get some quotes back, it's more important to me how they're advising you than the numbers they kick back. So I don't worry so much about shopping based on my credit score if I'm picking a lender for out of town or out of state because Dave can't help me out. It's more going to be how do they advise me? How much time do they spend on the phone? What questions do they ask me? Are they really preparing and choosing a loan program that's best for me based on my specific situation? Are they taking the time to do that? Or are they just flashing me a rate sheet and saying, this is what it'll be based on your credit score? Right away, if you're just getting a rate sheet and here's what it'll be, you're talking to the wrong person. And if you have someone who's asking you a bunch of questions and working through your own situation, you're working with the right person. So don't stress about the credit, drop of shopping. Don't even worry about having multiple people pull your credit. Give them all a credit score from one of your reporting agencies and see how they advise you. Then the right one will rise to the top quickly. Let them pull your credit. You take the 3-point hit. It's not that big of a deal. Would you agree, Dave?
100%. Yep. Well said.
Yeah. All right, guys, that wraps it up. Those were the bulk of the questions you guys submitted. I hope this video helps you get a sense of how to begin the process of preparing your credit to buy a home. What credit score do you need? 580 gets you started, 620 better, 740 to 780 or above gets you the best rates. Who can help you? Your trusted lender and realtor can help put you on the path to figuring this out and doing some credit repair, or even if you don't need repair, just bumping it up to get the best rates. Don't worry about having someone pull your credit and that affecting it a couple of bumps. That's not that big of a deal. But this whole credit landscape has a big impact on what it costs you to buy a home. So it's important to engage early and get good advice early. As always, we're trying to give you the best information you can so you make the highest quality real estate decisions you can from the comfort of your house. If you got anything out of this, we'd love you to hit that like button, click subscribe, and hit the bell so you don't miss another podcast or video with crucial information to help you in your transition into home ownership. Dave, as always, thank you so much for
Thanks,
your
Rich.
time.
Appreciate it.
We'll see you guys on the next one.
Thanks.